All right, folks. Let's begin this week's best stock charts off with a review of last week's performance. How did we do? We closed out a couple of positions. LOPE, that was a loss. We accepted a loss on that trade. That was a carryover from 2016, and we also booked a loss in BLUE. But other than that, we did a really nice job of trading DUST and NUGT. That was an options trade. So let's go over those trades really quick. So we were short of LOPE when it was at extreme overbought levels on RSI. It was topping out back on December the 9th and dropped back, and we were building a position in anticipation of a break below this lower band of support. It never happened. And on the 10th, the shares began to rally off the lows of the day. On the 11th, they actually broke out above the upper band of resistance. So we stopped out on the 10th due to the fact that it appeared that we were going to break out, which in fact we did. The following day, on the 12th, the shares rolled over, broke back down into this trading range. They'll probably come back down and retest the $58 per share level. Will we look to short once again? It's possible, but only if we close down below this key support level. Why else did we stop out? We broke out on RSI. We're pulling back now to retest the breakout point. So if we break out, we'll be happy that we stopped out of this trade. And if we break down, we'll look to get back involved with it to the short side. Now, another position where we took a loss on last week was BLUE. And note I'm talking about my losses. I'm not simply coming out and saying what we made money on. That's not how you learn. You learn from your losses so that you could validate your trading strategy to ensure that it's a sound strategy. If not, you make your corrections. You learn along the way. So BLUE, I bought after hours, which I normally don't do, here on the 9th. We had broken out above the upper band of resistance out of this bull flag formation. LABU, the biotech sector, it was really in fuego. Stocks like Illumina, they were rallying. And I was looking for shares that had yet to rally, but were setting up for a possible breakout, and BLUE was the candidate. However, the next day, no follow through to the upside. And when we broke back down into this bull flag formation, that was a bull trap. So we stopped out automatically. So a very small loss on the trade. And yes, we broke out once again. Will we look to get back involved with BLUE once again? Absolutely. But not yet. I'll be going over BLUE with members. Okay, now let's talk about Nugget. NUGT, this is the Direxion leveraged ETF, putting you long of the gold mining stocks. And I've been very, very bullish on NUGT going into 2016. I was bullish back in late 2015, enjoyed this rally higher all the way through to the summer, and we began scaling out of the position. Now we're reloading on NUGT, and we bought more last week. Now, what happened last week that got me all the more bullish? I went over NUGT last week on Best Stock Charts, and at that point in time, I said that I was concerned. I was wary due to the fact that we had yet to break out above this upper band of resistance. Now we have. I was also wary about these topping tails on top of these candlesticks. It implies that you have profit takers booking profits into strength. Now, last week, we did close off the highs of the week, so I'm a bit cautious still about NUGT. Now, I believe that once we clear $10.50, that the shares will go parabolic. They'll rip up to $18 to $20 per share fairly quickly. Volume rising sequentially, exactly what you want to see. So the weekly chart is looking rock solid. Now, to discuss our trade from last week, this is an hourly chart. NUGT broke out of this triangle formation, but unfortunately, it broke down. it rolled right over and was unable to rally and follow through on this breakout. Now, what we did was we went long of DUST, which hedged our NUGT position. Now, what had me skeptical about this breakout on NUGT was the RSI, the Relative Strength Index. Take note of the lower highs that were getting put in as we broke out to new higher highs. So we had a bit of a divergence on RSI. That was a big concern of mine. So we went long of DUST, and I'll go to that chart in a moment. But what we did when NUGT was rolling over, rather than stepping in and buying shares, I said, you know what? These shares could dip considerably lower, so why not buy the shares at a discount? How do I do that? What I did was, when the shares were pulling back, I sold to open put contracts. Now, you may be hearing puts, and when you hear puts, usually it means that you're betting against the stock. That's only if you're buying the puts. What I did in this case is I sold to open, meaning I was the casino. I was taking in premium, 27 cents per contract. And I bet that by the end of the week, meaning Friday, yesterday, that the shares would not close down below the strike price of $8.50. The shares recovered, the options expired worthless, and we pocketed the premium, which is over $500, not including commissions, but a very nice profit, cash in the pocket, and we went long of DUST in the pre-market on the 10th. We didn't get in at the lows, but we enjoyed this rally higher. We booked profits on the 11th, and then NUGT rallied back strong at the end of the week. So Dust, nice trade. NUGT, nice trade. Our core position in NUGT did really nice. Now, how did we know when to book profits on DUST? Well, when you're using a 60-minute chart, 30-minute chart, the 50-period moving average acts as a declining ceiling. So you know that there's a very, very good possibility that you'll see sellers move in as the shares hit the declining ceiling, which is acting as resistance, meaning the 50-period moving average. So we sold strength, and I will be looking to add DUST back again in the near future. Why is that? If I'm long of NUGT, why am I shopping for DUST shares? The reason is this, is that when you take a look at the dollar broke down below the lower band of support last week, which helped fuel the shares of NUGT. The problem with the dollar is this, is that we have yet to rally back and try to put in a new higher high or a double top and roll over. So we have yet to go through that process. And I'm not going to get comfortable until that event occurs, meaning we rally back, fail to take out the prior highs and roll over, or B, if we break out to new highs, well then, I'm not going to want to be long of NUGT. I'm going to be looking to buy shares of DUST on dollar strength. Now, I'm not convinced yet that the dollar is done going down. I think we'll continue to retest $26 per share, but eventually we're going to get a rally. What I'm hoping for is that we get a double top on the dollar like we had back here in March of 15, then the double top in April. Same thing again last year, November, and then into January, double top. What I'm looking for, again, is a rally off of 26 and an attempt to try to break out above 26.83, which marks the prior high. If we roll over and break down below $26 per share, you can bet your bottom dollar that gold, silver, the gold stocks, meaning the mining names, will be in fuego. They will be ripping through the ceiling. Now, how does the dollar look going into next week? Well, the euro did quite well last week. So dollar is not looking good. We broke out on the euro above the upper band of resistance, which is now going to act as support. We were oversold on the euro. Now, unlike the Federal Reserve, the European Union, their central bank, has only one mandate, where the Federal Reserve here has a dual mandate of ensuring employment and focusing on inflation. The EU has only one mandate, and that is inflation fighting. And inflation is on the rise in the EU. So Mario Draghi's last statement was that look to March for the Eurozone to end QE operations. So with that being a possibility, you're going to see the euro strengthen in anticipation of hawkish commentary out of the European Central Bank. So that's not going to bode well for the US dollar, but that doesn't mean the dollar is going to drop overnight. So we'll be looking for signs of dollar strength, implying that we may rally, and then we'll look to hedge our position using DUST to protect us from a rally in the US dollar. All right, so going back to my 2017 stock market forecast, I mentioned that inflation was going to be the name of the game. You would hear a lot about it in 2017. I referenced the commodity sector. I don't know if I spoke about the TIPS, the iShare TIPS. These are the Treasury inflation protected bonds. This is an ETF, trades like a stock. And you can see that ever since mid-December, the TIPS, which is a hedge against inflation, have been rallying. So you have institutions out there buying protection against inflation. How do I know it's institutional buying? Simple. Volume. Look at the above average volume. How else do we know that there's inflation out there? Take a look at your agriculture stocks, the DBA. I discussed this in the 2017 stock market forecast. It's posted on the blog. I'll link to it at the end of this video. The DBA, I mentioned, look poised to break out on price and on its indicators, and it's done so. We have now broken out on RSI, on stochastics, and on price as well. So you're seeing a lot of buying of agriculture stocks. Look at this double bottom setup. The DBA is looking good. Volume is above average. Now, why am I talking about inflation so much? It's because I think that we are in the early stages of a big bull move in precious metals and agriculture stocks and commodities in general. Some will do better than others. Now, you might be saying, Bob, the Federal Reserve, if inflation shows its ugly head, well, then they're going to rapidly increase rates. They're on a path to normalization. I don't think so. Remember that we pay less now with $20 trillion in debt in interest payments yearly than we did 8 years ago. And you may be saying, how is that possible? We doubled our debt. The reason is artificially low interest rates. And if the Federal Reserve were to normalize to say, let's say 5-6% Fed funds rate, that would be an extra $950 billion per year in interest payments that the Treasury would have to pay on the national debt. Where are they going to get that money from? They're going to borrow it. The Federal Reserve is going to print money, and they're going to crush the dollar. So don't expect rapid rate hikes anytime soon. The Federal Reserve is going to speak hawkish and act dovish. Let's talk about gold. Gold, I mentioned at the beginning of the year, was looking very bullish, and we are up about 4.25% on the year so far in GLD. Volume has been a bit anemic, though, and I'll be honest with you. I just went over my rationale with regard to the U.S. dollar and the fact that it's probably going to rally once again fairly soon, which is not going to bode well for gold for a couple of weeks because they trade inversely of each other. So I think that you have a lot of traders out there. They're waiting for that double top in the dollar. They'd like to see that in their rearview mirror, as would I, no doubt about it. And also remember that gold found resistance last week at the 1200 level. So we're at resistance. We're waiting for the dollar to try to rally back, try to take out prior highs, or fail, one of the two. And that'll dictate where gold is going to go and the gold mining names in 2017. So gold on a weekly basis is looking good. Again, we're at resistance, and it remains a watch. Other commodity names that we're watching, REMX, this is the VanEck Rare Earth Strategic Metals ETF. Why are we looking at the metal names, the rare earth metal names? The reason is that the situation with the Chinese is very precarious right now, and it's bound to only get worse before it gets better. And who has an almost monopoly on rare earth minerals? The Chinese. And on a technical basis, and with RSI, it is putting in, this is a weekly chart, putting in higher lows, and we're poised to begin putting in higher highs. On price, we broke out back in February of last year. We've had a strong 2016 and 2017. We have broken out above last year's highs. So the path of least resistance for rare earth looks really good to the upside. Volume is picking up well above average. Stokes putting in higher lows and higher highs. So REMX is a watch as we proceed into the coming week. The next stock that we're watching, GLNG, weekly chart. I discussed this last week. We were looking for a retest of the breakout point. We got it last week. You'll see this often. You'll see a stock break out, then pull back, and retest what was resistance should now act as support. It's a validation of the breakout. That's a good sign. So GLNG is looking rock solid. We have broken out on RSI. It's moving higher. Volume, though, is a bit of a concern. There's very, very light volume here. Stokes are hooking up, bullish. So we like GLNG. Last week I discussed Hack as a possible long. We were looking for a breakout, and we got it last week. So Hack, this puts you long of the cybersecurity stocks looking rock solid. We have an inverted head and shoulders setup on a weekly chart. Left shoulder, head, right shoulder. We broke through the neckline last week. Volume rose sequentially, looking good. So on all of these names, I'll be sending out alerts to members when we decide that the best risk to reward entry point is setting up, and then we'll send out that alert when we get long. FEYE, weekly chart. Last week, we broke out above the upper band of resistance. Volume was below average. So what I'm looking for in FEYE, we're looking to get long, but what I'd like to see is a retest of the breakout point, RSI double bottom setup, and we have broken out above prior highs. So the RSI putting in higher lows and now putting in higher highs, exactly what you want to see. So FEYE and HACK looking rock solid. Now, last week I also discussed CYBR. And the shares had a spectacular week last week. They gapped up higher. They were up nearly 8% on the week. Would I be a buyer now? No, I can't, because we're too close to resistance. Does that mean I wouldn't buy the shares in a breakout or a pullback? I absolutely would. So CYBR, I'm bullish on. Right now, it's at resistance. We're going to want to see a pullback, a consolidation, and we'll be looking to buy on a breakout of a consolidation. For those not familiar with technical analysis and what a consolidation is, this is a consolidation, a bull flag formation. This grouping here is a consolidation. So CYBR looking strong. I wouldn't be chasing the shares, though, into resistance. Macy's. Okay, Macy's. Daily chart, RSI at 19.05. Now, this is technically an extreme oversold stock. I would not be a buyer yet of Macy's. I think that these shares can go lower. That being said, you're seeing a nice consolidation here at, let's call it, 29.69. We may rally briefly, but I think that rally will fail. And I think we're coming down to a bare minimum to $29 per share. The 50-day moving average is rolling over. So while I want to buy Macy's as an extreme oversold long trade, the shares aren't that oversold enough like they were back here, back in May. The last time I spoke about Macy's, we were bullish back here, and the shares rallied from a low of 29.01 all the way up to 44.99 before they rolled over once again. So we're going to probe these lows. I would not be a buyer yet. Members, I'll send out an alert when we decide to pull the trigger on Macy's. Healthcare, the XLV. I had some concern about XLV at the end of 2015 with this head and shoulders setup, which actually broke the neckline, but the shares recovered. And in fact, we have now broken out above this upper band of resistance. Last week, we pulled back, retested the breakout point. I'm bullish on XLV. Volume, while was above average, net on the week, we had very little change, down 0.4%, pretty much unchanged on the week. So you had a lot of churning going on here. So XLV looking good from a higher level view. Using the weekly charts, not just the daily charts or intraday charts, we're looking for swing trades, longer term positions. Names in the medical arena that I like a lot are names like Second Sight Medical Products. Now, the shares were behaving well earlier in January. The problem is that last week they announced a secondary offering. I view that as bullish. Why? It had to happen. So it's out there. It's been put to rest. Now we can wait for the shares to settle down, and then we can begin buying on strength. Take note of how last week we retested the lows seen back in November, and it held. If you continue to see consolidation along the support level, that's a bullish event. So we're looking to get long of EYES fairly soon. So members, I'll be sending out an alert. Lumber liquidators. I was bullish on lumber liquidators back here in June when we broke out above this upper band of resistance, and the shares rallied all the way up to $20.10 before pulling back. Now, you could see that back here, the week of November the 7th, we flashed a bullish key reversal off of prior resistance, which is now acting as support. We rallied, we're now pulling back. So we have a series of lower highs. The question is, do we put in a higher low or retest the support level again? Either way, I think that there's a good risk reward trade setting up here and an entry point on lumber liquidators. So we'll be looking to open a position fairly soon on lumber liquidators and then add more on a breakout above resistance. We're going to need to see these Stokes hook up like you're seeing here on Williams percentage R. They're hooking up. The lines are hooking up. The line on the Williams is hooking up, looking good. Last week we saw a doji star formation, a sign of indecision on lumber liquidators. We need to see a breakout on RSI. So members, more to come on lumber liquidators. Facebook, I mentioned last week we'd probably see a rally on Facebook. We got it. It was up 4% last week. I think it goes higher. It's probably going to go up to let's call it 130 to 135 per share, which was prior support. That prior support level is now going to act as resistance. We broke support back here in October. Volume below average, but rising sequentially. Stokes hooking up. Amazon, I mentioned last week, they would probably move higher. They did. They broke out above support. Expect higher highs as we proceed into earnings. Next price target, I think we can head all the way up to 847.21 in the coming weeks. Just beware of earnings. Alibaba, we were bullish. The shares moved higher last week, 2.5%. I am not as optimistic this week as I was last week. Why? Couple of reasons. One, we hit resistance last week and we backed off. Sellers moved in. So the people that bought back here, they want their money back. They're selling. Volume is a big concern. Well below average, although it is rising sequentially. So the game plan with Facebook, Amazon, and Alibaba is to watch the daily and intraday charts. We'll discuss them on Market Wrap or Morning Update with members, and we'll look for good setups that provide us a good risk-reward entry point. And that's it, folks. Don't forget to sign up for our discussion group. Some really good conversations going on there. Some great charts getting posted. Really impressed with the caliber of talent that we have in the forum. So please join us there. Just click on that link below. You'll be taken over to the discussion group and just send us an invite request and we'll get you in there right away. Members, let's begin with the week ahead commentary, beginning with Market Pulse Check, which is where we review the health of the overall markets. Then we'll talk about our positions and our strategy for the coming week. Okay, members, let's begin market wrap off with a review of what's transpiring next week besides an abbreviated week. We have earnings that are set to be released. A lot of the regional banks will be releasing earnings. Some of the airlines, transport stocks.